it's been interesting for me to get to know about Axiom since David invited me to chair this event today. Founded in 2006, of course. Both David and Jérôme have an awful lot of experience in this field at Société Générale, at SocGen. Axiom, of course, specializes in subordinated bank debt, which, of course, is a niche market, but it's a niche that's worth well over €1 trillion.
Well, there are various figures on that topic, but between 1.5 and 1.9 trillion, depending on what you consider an investable size of issuance. If you stick to what is above 200 billion, it's roughly 1.5 to 1.6 trillion.
So it's a niche market that also happens to be the elephant in the room. I'm going to start with you, David. Of course, we have had a lot of instability in the European banking sector since 2008. Do you think there could still be a major systemic issue in European banks?
Well, it's a question which remains quite controversial today. Recently, we've seen many different studies evidencing, capital needs which seemed incredibly high. But when you look at what the European banking system has done over the last few years, they raised roughly 500 billion euro. Today, most of the European banks stand with a Tier 1 ratio at roughly 12%. So these figures are figures that come from the EB and are quite recent. They date from October 2013. And the main problem of the European banks today is not anymore to release assets or to raise capital, but is rather to see how they will again deliver profit. The return on equity that you can see on European banks today are pretty low, and that's really their main issue today.
And do you think, Jérôme, that we're on for a scenario going forward of muddle through rather than another systemic crisis?
I believe there are two components in your question. The first one basically is there going to be another bank going bust? And the second one is it going to have any systemic impact? I think the answer to the first one is yes, there is. Because I think there is still some work to be done, and it's probably something we're going to discuss later, but there's a reason for the asset quality review and the stress tests, and it's not just to keep regulators busy. There's a good reason. But on the other hand, both the ECB and banks themselves have done a lot of work in terms of isolating the black sheeps and trying to be sure that any failure would have no systemic impact, and I think it's working. And actually, we've seen it already in 2013 because we had the banks in Cyprus that went bust. We had the banks in Spain, like Bankia, like Banco de Valencia, and SNS. No one cared. And SNS in the Netherlands and Coop Bank in the UK, and really no one cared because they had no systemic importance anymore. And I think it's going to be the same story in 2014.
Just before we get on to the present and the future in terms of regulation, let's just talk a little bit about what has happened since the Lehman collapse. Which countries do you think have done a good job of banks cleaning up their balance sheets, David, and which companies are the laggards?
Well, I think the first thing which is important to have in mind is the regulatory changes, and there's a big difference between the attitude of US and Europe. In Europe, really regulators, under the pressure of the public opinion, under the pressure of politics, have pushed banks through massive and very quick changes. So they went into Basel III probably with 5 years in advance. If you look at banks today, they all cope with many of the Basel III standards, which should not be applicable before 2019. And this is a big difference by comparison to the US. US banks are still operating under Basel I, while European banks operate under Basel 2.5 for the asset side of the bank. And under Basel III for the liability side of the bank, pretty already. So there's really a very strong change that happened in Europe. So that's the main thing to have in mind. Then when we look in detail at Europe, of course, the banking systems are not alike. One of the key elements in the crisis was the real estate financing system. If you look, if you try to measure the losses in Europe, the very interesting metric is the link between the recapitalization need and the importance of the real estate financing system. It's very simple. Spain, Ireland, UK, Netherlands, and of course the US were a banking system where the real estate financing system was an asset value-based system. And in this system, when the economy contracts very quickly, this translates into losses in the balance sheet of banks, and it triggers recapitalization need. But the most important thing is that it's pretty difficult to measure and to control the speed at which these losses translate into the balance sheet of banks. By contrast, other countries went pretty late in the crisis. We're talking about Italy today. The Italian banking system is a domestic retail-based banking system, very boring. So it hasn't been under pressure in 2008. Started to be under pressure in 2011, 2012. But it's really now that the Italian banks will have to change and make the effort and clean their balance sheet, which hasn't been the case before.
How about Germany, Jerome? Often presented as the good guy, the good cop of the European banking sector. Is that stereotype true? It seems to me that the Landesbanken have many issues.
They are the good guys in terms of marketing, that's for sure. In terms of banking system, basically you've got three pillars in the German banking system. You've got the Sparkassen, which are very retail-based. No one knows them, you know, they don't have bonds on the markets or anything. So it's really, I would say, a kind of hidden banking sector. Then you've got the Landesbanken, which used to be central banks and now completely diversify their business model. And then you have the private banks. And the problem is that Germany is such a huge banking market with so many banks that competition was very hard and wasn't sound and wasn't economically meaningful. So banks had to do two things. Lend at any price, you know, completely stupid prices because there was a competition of the Sparkassen and of the Landesbanken, and do, you know, things they didn't know very well, investment banking, investing in structured products, etc. There was a very funny thing during, the bubble years of the fixed income market. If you wanted to find the most well-paid individual in any bank, you only had to go to the fixed income sales desk in charge of sales to Germany. The guy was a millionaire, you know, he was selling crap to Landesbanken and making millions. And, you know, that's what happened. So at the end of the day, they bailed out the banks with hundreds of billions, much more than any other country in Europe. Of course, there is the Bund behind, so it's, there's a lot of money.
The sovereign.
The sovereign is very strong. Yeah. But the banking system, maybe apart from Ireland and Slovenia, I would say it's the worst in Europe.
And then Spain, again, contrary to lots of stereotypes, is actually at the better end of the spectrum, David.
Yeah, well, there are two, I would say there are two worlds in Spain. Of course, we know pretty well today the worlds of the cajas because they've been quite mediatized and the restructuring plans have been pretty mediatized. However, in Spain, you have two fantastic banks, at least Santander and BBVA, which rely on a universal model and which are one of the most profitable banks in Europe you can find. These banks went through the crisis without making any loss. They belong to the small club of banks which have been able to raise their regulatory capital only on profitability without doing any capital market increase. So there has been this contrast in Spain for a long time. However, Spain today has done the job. thanks to the restructuring of the cajas, there has been a massive exercise done by Oliver Wyman and, of course, the Spanish Central Bank. And today, in view of the AQR, we have a quite clear and sound situation in Spain.
We'll come on to the stress tests impending in Q4 of this year, which really is sort of the Banquo's ghost at this event. It's incredible to me how few mainstream commentators have identified the importance of these upcoming stress tests. But you would suggest at this stage, gentlemen, that you wouldn't be expecting any nasty surprises to come out of, for instance, Spain during these stress tests.
I mean, the first stress tests were done by Oliver Wyman, and the second ones are going to be done by Oliver Wyman. With the same banks, the same balance sheet, the same economy, the same everything. So, you know, just no surprise.